Welcome back to the Manor. Julian McBain here, and we are back with Personal Finance for Gamers here on Entropia Universe. And of course, we're hunting the weak Panleons again because it is my in-game goal this year to actually make a profit in Entropia Universe as opposed to cutting a loss. My losses have gotten smaller every year. That's great. This year, I'm aiming for an actual profit. That means playing conservatively and knowing how to do it. So for those of you who watch for the gameplay, thank you so much for your support. That is my goal, as I'm sure you all know. Okay. Today we're doing personal finance for gamers, of course, and we're going to be talking about mortgages. Mortgages are a very particular type of lending pattern. They come in installment and revolving, so we're going to take some time to go through that. And this time I'm going to make sure I'm not talking to myself because I just spent the last 7 minutes doing that. I forgot to get my microphone set up because I'm doing VR content. We'll get into that in a second. But if you're new to the channel, before we get started, if you're new to the channel, welcome to the Manor. Please take a moment and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. Also, please consider going to patreon.com/JulianMcBain if you want to support my work. If you do, you'll get exclusive content, including the ability to download Personal Finance for Gamers, the ebook that I wrote that I'm basing all this content off of. I do expect to write a second edition sometime in the next year to 2 years as all the changes to finance with this massive inflationary bubble time to settle out. I'll go through and I'll tweak it so that it's more up to date. I feel that doing these videos now is really important because it gives you information while things are happening so that you can get your finances in line to survive the inflationary bubble better. And if I had known what was going to happen, which I suspected but didn't really know back in 2020, I would have started this in 2020. So I tried, but I didn't do as good a job as I'm doing now. Like this time I'm really breaking it down. So if you want to know the source material, it's all at patreon.com/JulianMcBain. Become a member. I only have a $5 tier. I am aiming to have 1% of my subscribers be members. I am short of that goal. So please, if you think I'm worth supporting, please consider going there. You get exclusive content every single month. Okay. So first, before we get into all of the nuance of mortgages, let's define mortgage. When people think mortgage, they think house payment, which, fair, it is a house payment for some mortgages. All house payments are mortgages, not all mortgages are house payments. Okay? So, what is the definition? There is an actual financial legal definition of a mortgage, and that is any form of lending secured by a dwelling. And that dwelling can be any form of dwelling. It can be a home that you live in. It can be a home that you rent out. It can be a duplex. It can be a triplex, a fourplex, an apartment building, or even a commercial space. Although commercial mortgages have more nuance to them, and we're not going to get into those. They fall under the same auspices in most cases as standard mortgages. Commercial's got some tweaks to it. We're not going to get into that. That's more complicated than we're going to worry about. But that is the definition of a mortgage. Any form of lending, whether it's installment or revolving, secured by a dwelling. What does that mean? If lending is secured by a dwelling and you fail to pay it back, the bank will foreclose upon or reclaim your home from you. That's what that means. That means the bank will reserve the right to evict you if you fail to pay back your debt. That's why it's very important when you have a mortgage to prioritize making sure the mortgage is paid. As long as the mortgage is paid, the bank can't throw you out. Now, there are some other requirements that mortgages carry, such as you have to have homeowners insurance or rental dwelling insurance for those that have a mortgage on a dwelling. They're going to expect it to be insured because if something happens to the home, they want to make sure they get their money and the building is going to be rebuilt. Banks' interests have to be taken care of. That's their job. And we will get into things like that when we get into the insurance section of Personal Finance for Gamers much later. Yes, I am going to cover insurance, which, full disclosure, is my current profession. I've been in personal finance for going on 10 years now. In fact, in June, I'll have been doing this for a full decade. I've worked in banking, I've worked in investments, and I've worked in insurance, which is why I'm covering all of this for you. Okay. Mortgages are also, we've talked about leverage and we've talked about liability. Mortgages are the most common form of leverage outside of an auto loan. And it's a much better leverage than an auto loan because as long as the market stays stable, you'll never be underwater on it. An auto depreciates faster than you can pay off the loan. With a home, in most cases, 2008 notwithstanding, the home either appreciates or stays stable as you pay the loan off. That's a good place to be because that basically means that, whoops, no, stop. Good God. This is what happens when Entropia Universe decides it knows better than you do. This means that over time, you're gaining value, known as equity, in what you're paying for. It's a form of wealth building, and it's generational wealth. Most homes are generational wealth because even if your children, your descendants, decide not to keep the home after you pass, they can split the money up and continue to build wealth in your family. So, what is a mortgage as a form of credit? From an academic perspective, it is the best form of credit you can have. And the reason I say that is because a mortgage has the lowest interest rates for the highest lending amount. Currently, the average interest on a mortgage is anywhere between 2.75% to 3.5%. And there's going to be some fluctuation in there, but that's really low annual percentage rates. And it is an annual percentage rate. That's how much you pay on your principal year over year. Yes, you can get down to a per diem and find out how much interest you're paying per day. We're not going to get into that right now. I've already covered that when we were talking credit cards. But the amount you pay for the sheer volume of dollars you borrow is the lowest possible. And that's done for a couple of reasons. One, the bank knows it's going to get its money back. If you fail to pay back the loan, they simply take the house and sell it. And then they're making a profit. Or at least they're getting back what they lost on interest. Two, it encourages people to buy homes, which is supposed to be, or at least it was until the last 2 years, supposed to be part of our American culture. And I know it's part of European culture to a certain extent too, although I don't know to what extent. I've never been to Europe, full disclosure. So for my international viewers, please leave a comment on how important homeownership is in your area. I know that in the United States, owning a home with a white picket fence with 2.5 children is kind of the whole stereotypical American dream, which has, I know, become much more difficult for millennials like me and and for the Zoomers that are up and coming. It's going to be even harder. So, but that's why they're low priced relative to other forms of lending, is to make that more possible. Not only that, but the extensive time period that the bank has that loan out, they're going to make the money they need off that lending over the 30 years, even at a low annual percentage rate, because it's extended out so long. So it is the best form of credit from an academic perspective. Just be aware that the sheer volume of dollars you're borrowing does mean you're going to be paying it back for long periods, and the bank is going to get a lot of money from you in interest. And we're going to go into like payment strategies and things like that toward the end of the video, so don't worry about that. So why is the best? I've already been through. Okay, I actually got through all those bullet points. So, okay, what are the different forms of mortgage? So when someone says mortgage, they're generally talking, unless it's from an academic perspective or you're talking to an actual banker, they're going to be thinking about their primary mortgage. It's the first loan they got on the house in order to purchase the house, or it's the loan that they refinance the house into. It's a first position lien. This is important because there are 3 positions on a home for liens. A lien, to get in there, a lien is the interest a bank has on your home when you have a mortgage. So when you take out that loan, the bank puts a lien on the home, which allows them to take the home from you if you fail in your obligations. That's what a lien is. So a first position lien means that they get the money first on the sale. That's your primary mortgage. That's what you bought the house with, or you refinance the house into when you refinanced it last. It has the highest ability to lend. You can usually borrow anywhere between 80 and 100% of the value of the home, especially if it's the first time you bought a house ever. It also requires the absolute most paperwork. I have seen mortgage files thicker than this notebook. Okay? I wish I was making that up. This is a 5 subject, so it's thick. It's like 2 inches. They need documentation for mortgages. They need that documentation because they need to know that you can pay them back. And I'm going to give you some tips if you're going for a mortgage or if you're thinking about a mortgage. I'm going to give you some tips right now on securing that mortgage. 1, ask early about what you'll need before you even go house hunting, especially in today's market. 2, be prepared to have to supply documents in a timely fashion. Nothing screws up a mortgage more than delaying giving documents to your banker. 3, don't take out any other loans for any other reason while you're in the mortgage process. Nothing screws up a mortgage faster than taking out a loan for something else, whether it's a car or refinancing your credit cards or anything like that. Don't touch them. Soon as the house closes, then do the other lending. So unless it's like a dire emergency, and then talk to your mortgage consultant about it first, no other forms of credit for any reason while you're trying to get a mortgage. You basically lock yourself out of getting any form of other credit from the time you start the mortgage process until you close on the home. You better make sure that ink's dry before you do it. Okay. First mortgages, first position mortgages are also good for refinance. What does that mean? Let's say you have your home mortgage and you've paid off a third of it, but doing renovations, stuff like that, you have either taken out a home equity loan or more likely you've run up credit cards, things of that nature. You can then refinance the home. Let's say you've been paying on the home for 10 years, it's a 30-year mortgage, and you want to pay off that $20,000 in credit card debt that's got like a 30% interest rate. You can refinance the home. You go through your bank. Refis generally have, they're called refis, refinance, refi. Refis have a lower underwriting requirement in many instances. Oftentimes you can convince the bank to pay the closing costs. Not always, but often. And it benefits you because you're dropping your interest rates drastically and you'll pay it off. While it still extends it out an extensive period of time, the amount you'll pay for the money you're borrowing will be less. So you'll end up paying less in the long term than you would have otherwise. Okay. Second position and third position mortgages. These are known as home equities. Home equities are lending based upon the amount of equity, and I'll get into what that is in a minute, that you've built in your home while you've been paying the home off. Now, let's define equity. Equity is not some social definitional garbage when it comes to home finance. It is a financial term. Equity actually has 2 different meanings to it in finance. In investment, it means ownership in, and actually it means the same thing, but it has different relationships. It means your ownership interest in something. That's what equity actually is. It's your ownership interest in something. So, your ownership interest in your home is your equity in the home. Your ownership interest in a business is like your stocks. That's your investments. That's your equity in that business. So it's your ownership interest in the home. Over time, your ownership interest in the home grows as you pay off the bank's ownership interest in the home. That is the amount of money you borrowed from them. A home equity borrows from the bank money based upon your ownership interest, giving that ownership interest back into the bank for more financing. There are 2 main types of home equity products. And I'm sure that there are half a dozen specialty products out there. We're not going to get into those. We're going to talk about the main ones. And these are ones I have actually done. I've never done primary mortgages. I have, from personal experience, done the next 2 products. Home equity loan. A home equity loan is your baseline second mortgage. This is what people call second mortgages. It's exactly like a primary mortgage, except it's a second loan on money you've already paid off on the primary loan. It's usually for something specific. Normally you take out a home equity loan for paying off credit card debt, or building an addition, or building like a deck. Oftentimes it's not even with the same bank, because some banks will have special pricing and all of that wonderful stuff, and that's good. Then you use that, you ride out that pricing until the market goes down, and you can get a refinance, and you can refinance the whole thing as a first mortgage again. Benefits to a home equity loan. 1, the home equity loan is always a second position mortgage. It can never be a first position mortgage. If you've paid off the house and you get a first position mortgage and you want it to be installment, it's going to be a mortgage. It's not going to be a home equity. 2, underwriting is far less for a home equity than it is for a primary mortgage. That doesn't mean there's no underwriting. It doesn't mean you won't have to submit documentation. If you have a really gray past, it might be close to what a primary mortgage is, but generally it's not. And if you go through the same bank that your primary mortgage is through, it'll be far less because they've already got that crap. Downside. It's literally just the same thing as a mortgage when it comes right down to the mechanics of it. Yeah, there's a lot of things you don't have to deal with, but basically you're adding an additional payment on the same home for money that you had originally already paid, and it works the same way as a primary mortgage. That's really the only downside. And of course, you can't take out this product when there's no mortgage because then it would just be a mortgage. Home equity lines of credit. Full disclosure, this is my favorite type of lending. It was my favorite type of lending as a banker. Why? A home equity line of credit is a second position mortgage that is revolving. Now, you can take more out on a home equity loan than you can on a line of credit. The interest rate on a home equity loan will be lower on average than a home equity line of credit. Why do I like the HELOC is what they're called, HELOC, home equity line of credit. Why do I like HELOCs better? Because they've got the most use for the lowest interest rate for the most dollars you can use. Here's the benefit of a home equity line of credit. If you are someone who does a lot of work on your home, as you pay the home equity line of credit off, you can access that credit again. The pricing of a home equity line of credit is drastically lower than that of a credit card or personal line of credit. Not only that, but you can access it as cash just like a personal line of credit out of your own bank account in most circumstances. And oftentimes, not all banks do this, not available in all areas. Oftentimes, banks are willing to issue you a card that you can actually take money off of directly from the home equity line of credit. Now, there are limitations to that. They often have minimum withdrawals from them. There are payment reschedules, things of that nature that you need to pay attention to. But if you're going to take money out on a revolving basis, the HELOC is by far the most flexible for the dollars you're paying in interest overall, bar none. And I challenge anyone in my profession to correct me in the comments. And I'm not saying that to be an asshole. I seriously mean that. If you have a better product that you think you can come up with that's not specific to your institution, like you can find it at most financial institutions, drop it in the comments. I would love to be challenged on this because I have yet to find it. I've been looking. Please correct me. Okay. There's one other advantage to HELOCs in that a lot of HELOCs, a lot of banks offer an option in a HELOC where if you need to take out a bulk chunk of money from your HELOC for, say, repairs or renovations or to get rid of that high interest credit card, you can often lock in a fixed rate for that chunk of money and have a separate payment for it. So it acts like a loan within a loan. And depending on the bank, the chunk of that payment on that chunk of money counts toward your minimum payment for the HELOC overall. Again, check with your individual financial institution. HELOCs have a lot of variety they have some limited variety to them on how they operate. Each bank has its own rules. That's important to keep in mind. So, what are the disadvantages to mortgages? Well, the biggest one I've already been through, the sheer volume of paperwork for a mortgage and the time it takes to do one. You can get a personal loan taken care of in 2 weeks on the outside. Like the last personal loan I took care of, credit card consolidation loan, took 14 days by the time everything was funded. Like from the time I applied to the time everything was funded, 14 days, it was less than 14 days. That was it. Beginning to end. And that's a long period. Like most personal loans, I'd write a personal loan, they'd walk in, ask for a loan, and if it was approved, I'd hand them a check or it would be dumped into their account same day. Now, if they're paying things off, the bank usually pays it off themselves by sending it to the other financial institution. That's different. That means funding takes a little bit longer, but funding from a direct perspective, it could be as little as 3 business days. Mortgages, Anywhere between 6 weeks and 90 days is the average for mortgage products. HELOCs can be as little as 30. Don't count on it. So longer cycle, more paperwork. That's the big disadvantage to them. And of course, if you fail to pay it back, they take your house from you. So if you're going to do it, be responsible. Okay? You can't, it's much harder to recover from a foreclosure than it is from other defaults. That might not be fair. But it still looks really bad. So, okay. And those are mortgages in a nutshell. That's really a nutshell version of it. Every mortgage product is slightly different. Mortgages tend to have underlying investors, they're called. So they'll be like, you'll have mortgages that are just given by the bank. And then you'll have FHA loans, VA loans, Fannie Mae, Freddie Mac, all of those different government owned agencies or government organized corporations that guarantee loans to banks and stuff like that. They're called the investors. Each of them have different rules. That means that even within a single standardized mortgage product, each one's going to have a set of nuances based on who the underlying investor is. Just be aware of that. Some loans are more flexible than others. Obviously, like VA loans are going to have more flexible criteria than, say, an FHA loan or a Fannie Mae loan. Again, those are things to keep in mind. Those are all things you want to talk to your mortgage consultant about. It's very important that you're educated on this sort of thing so that you have what you're armed with the information you need. So one final word on mortgages. If you currently have a mortgage and you're watching this anytime within the 3 to 6 weeks after this video releases, please, for the love of God, if you haven't done so in the last 12 months, go to a mortgage consultant and talk about refinancing your home today. Money is cheaper now than it ever will be ever again in our lifetimes. I'm predicting. I doubt this will ever happen again. Now's the time to refinance and lock in a rate before it's too late. I'm not saying that because I'm working for a bank. I don't work for a bank anymore. I work for an insurance agency that we don't do mortgages. We don't touch banking at all. I have no financial incentive to tell you this. And I'm not saying that now's the time that, I'm not saying that a refinance is going to benefit you right now. I'm saying check. Check before the rates go up this year. That's all I got. Thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. And as always, I really appreciate the support. Huge shout out to my patrons, Red, Kryptonite, Jay Lamberton, Devin327, Melky, and Robert J. You guys make this stuff happen. I appreciate all of you. And if you want to be up on this board next time, please go to patreon.com/JulianMcBain, become a member, and we will see you in the next one.